Thank you. Hello, everybody. If I did not trip and fall. How are we doing? We're gonna talk market stats. You guys are no doubt excited. All right. I want to get a couple things going around. Start here. Throw one here. Maybe one here to go back there. All right. Maybe one here. So you guys go ahead and take a look at that.
Right over 1982.
Let me know what you think.
The 80s.
This is a photocopy of a document from 1982, and it was called, is it Banco Notes or just Bank Notes? I don't know if we're playing Scrabble rules or not, but July 8th, 1982, and owner-occupied 30-year fixed, wait, where'd it go? Owner-occupied 30-year fixed, 16 3/4. Non-owner-occupied, 17.5%, and that's with 3.5 points. Holy cow. So suddenly 6.7 doesn't seem like the end of times, does it? Suddenly it doesn't seem like the absolute end of times. And yet rates doubled on us from 3 to over 6, right? We know rates doubled on us. That's going to change things a bit. Maybe you guys have been noticing that. We're going to talk about that. You'll also notice that we wrapped up a year, about two months ago, 2 and a week months ago. And so we're going to talk about the year as a whole and kind of how things wrapped up as a year, because probably only got about another 3 weeks or a month to talk about that, and then it's old news, right? So the second half of last year in particular, I think, is illustrative. That's the word, right? It's going to be illustrative of kind of what this year, at least the first half, has looked like and will continue to look like. Some things rates can touch 5.9 by summer or by early third quarter. I don't know. Inflation data doesn't seem to be as encouraging as it had been. So let's see what happens there. I want to do some slides with you guys. So I will be going through a few slides. And then I do want to spend some time in InfoSparks doing some custom stuff for you guys. All right, let's see. I got my short and long. You guys don't want my long. We could be here for hours.
Is that your second home date? I was going to say, is that your...
No, don't I wish. Don't I wish. That was...
Support, perhaps?
Yeah, that was Banff. Banff, yeah. I've been there once, and I really want to go back. Okay, let's get cruising, guys. So we're going to fly through some of this because you guys are a sharp bunch ahead of some other shops, and so we'll fly through some of it. But when you do data for a living, let me have some fun with videos and pretty designs and stuff. All right, anyway. You are here. You will be drinking from the fire hose, so wargle, wargle. Expect to be overwhelmed with information. I will absolutely share slides with you guys so you can sit with them and have a little bit more time. W. Edwards Deming says, without data, you're just another person with it. And I feel pretty strongly about that. I also feel strongly that we are drowning in information and yet we're starving for wisdom. I really do think so. This is what some of you have in front of you, and you'll notice that's right. Rates starting at 18%. And Jim Duffy, feel free to page him. I bet he'd pick up. I bet he'd answer your page.
What's the area code?
It's got 612. There weren't any back then because it was like the 5 people that had pagers. Yeah, we didn't need an area code because there was only like 10 of us that had pagers. Anyway. So, just good to kind of keep that in mind, you guys, and to ground ourselves a little bit historically. So what's been happening? So this is from NAR. So this is the national market. Guys, green territory, sellers markets. Blue territory, buyers markets. Going all the way back to 99. What do you see? Can I get my laser going? Let's get a laser going.
Ups and downs.
I see some ups and downs.
Predominantly in the sellers market.
Mostly in sellers market territory, right? We were about 4 or 5 months of supply. And then into the crash, we saw 10, 11, 12 months of supply. We have healed and come right back past the neutral market into sellers market. And it's been a strengthening sellers market for years, right? A market with shrinking inventory, right? Good for sellers unless they have to be a buyer, which most of them do. And so then, we see listings kind of decline because of that. Here's what everyone's freaking out about. The W, that leg of the W is higher than other parts of the W. And that's the first time we've seen that in a while. What I think is missing in the media and in the kind of national picture is we're still in a seller's market, right? Sellers still have power and pricing power and negotiating leverage, and yet not quite to the same degree as they once had. So I believe that a lot of buyers think, you know, we were kind of here and now we're here, right? A lot of buyers think that now we're here and we're just not there. Right? That's the fact. And thank God facts still matter. Someone said we're living in a post-fact era. Please no. Please no. The good thing about facts and data and science is that they're true whether you like it or not or believe it or not, right? So long-term pricing, you guys, let's just look at the long-term history. All this comes from North Star, and we're looking at the whole Twin Cities region by default, unless we zoom in and hone in, and we'll talk about that. So guys, going all the way back to 1960, look at pricing. Right? Slowed down in the early 80s, right? With inflation. So we kind of synced back up with our trend. How about our bubble? Look at when we were inflating our bubble. Pretty evident. It's pretty evident there, pretty clear that we were ahead of our channel. This channel is our long-term growth rate. When we're above that channel, we're a little frothy, little hot, right? When we're below that channel, we had a cool down. So look at 2005, 2006. That was our party. That was our hangover. Right, pretty clear to see. And when you pull back the rubber band, it snaps back past center, right? When you pull back the pendulum, it always swings past center. It never stops right in the middle. Nothing works like that. Not stock markets, not nothing. So now, right, we've seen ourselves sort of get back on track, and we're kind of on the bottom edge of our channel, of our long-term growth rate. A couple things to note. First of all, do you guys see the rate of price growth accelerate over the last few years? Look at the slope. Definitely saw some acceleration. The second takeaway is, are we in bubble territory like we were? The data sure doesn't support that, right? I suppose it's possible in some ways. I kind of don't think so. And this doesn't support that. Really clear that we were just way above where we should have been. By the way, when that happened before, notice we converged with trend. That's why we call it a great mean reversion. Over a long enough period of time, everything reverts to the mean, kind of goes back to average. Because it's like a solar system. It has gravity. It pulls you back, right? No matter how far away you get, it kind of pulls you back. That's why it's an average for 60 plus years.
It's a 5.4. I've heard 4 additionally. 5.4 more in line with.
I show 5.6% before inflation, so about 5.5%, and after we take out inflation, which has been about 3% long term, 6-7% lately, 1.5% coming out of this period. So after we account for inflation, it's about 2% per year. So houses keep up with inflation and then deliver you 2% returns on top of that. Yeah. Sometimes gold keeps up with inflation, but can you live in your pile of gold?
No.
It's not going to work that well.
I mean, some people.
You're going to get water intrusion. You're going to get water intrusion. Anyway, fight the water battle. Water will get where water wants to go. All right, guys, Twin Cities housing market activity. You know what? Let's skip that one. Let's go to the longer term view. This one back to 1967. How many of us woke up this morning thinking we'd see charts back to the 1960s?
It was coming here.
It was coming. All right. Well, one of you. Life is full of surprises, you guys. Life is filled with surprises. Okay. 2 things happening here. Seller activity blue, buyer activity red. New listings in blue, closings in red. What do we notice? 2 things. Sorry?
They're in unison.
They're moving pretty much in unison with a few important exceptions here and here, kind of Mount Everest and K2, right? Where's Cotty? Doesn't Cotty climb these mountains? He's probably at base camp on Everest right now. Anyway, God, is that going to... Guy's going to turn, when he's 90, it's not going to slow him down. He's going to be summiting. Anyway, so guys, bubbly times. Look at the supply buildup. Look at the supply buildup. Did buyers come along for the ride? Not really. How about here? They tried as we had adjustable rate mortgages and ninja loans, no income, no job, no problem, right? And then they got laid off and Lehman collapsed. What did I miss?
Funny acronym.
Oh, ninja loans. You guys have heard of that?
Yeah.
No income, no job.
No job.
No income, no job. What's the A? No income, no job. Accepted.
There you go.
Applicable, acceptable. Yeah. Awesome. Yeah, no income, no job. Awesome. Anyway, okay, guys. So look, when Lehman collapsed and people were laid off, the demand wasn't there to absorb all that product. What happens when there's excess product and not enough demand for it? Prices have to adjust. I like to use the example. It's a little bit of a spicy example. I'll use it anyway. Macy's has a lot of two-piece swimsuits still on the racks, but it's October. What do? They have excess inventory that's not in demand. What do? Cut the price in half and put it on the clearance racks. That's what happened when we had excess supply. Cut the price, well, by 10 or 20%, not quite 50, usually, and then it'll sell, right? It'll clear the market of that excess. Lately, what do we notice? Little bit of a downturn given what's happened with interest rates, what the Fed has done to try to cool our economy and cool the market down. Something important with what you see happening in blue and red, the relationship between the two, right? The relationship between the two has remained close, tight. Some people were fearful that sellers would go up trying to take advantage of pricing. And then buyers would, buyer activity would come down given higher rates. And that's not really what's happened. They've kind of moved together. If we saw supply rise and demand fall, that gets us into trouble, doesn't it? Timmy, thought.
Here's where I think quantitative research and qualitative research can sort of converge or diverge. We're seeing a lot of really hot buyer activity around, good and even average listings right now.
Yep.
It would be easy to think that perhaps if we had more listings, because mortgage rates are high, as long as they stay this high, that we would continue to see the red line down low. I would argue that there's a hypothesis that might be able to see actually both of them go up. If blue went up, it could pull red up with it, just because there are still relatively a lot of buyers compared to listings.
Yep.
I think it's the what's slowing down transactions just as much as the short inventory as it is.
Yeah, that's what we hear still. And I'm somewhat surprised to hear different shops actually in different parts of town say that you're seeing multiples on 300, 400, 5, even 1.2. I've heard even 1.5. You and I were talking about that, Tim, a couple weeks ago. I mean, 1.5s in multiple offers. Maybe that's expected because a lot of those folks use cash and don't finance the deals. So I don't care if rates are 2%, 20%, or 200% if I've got cash. Same goes for BlackRock. Blackstone? BlackRock, yeah. When you have 20 trillion in the bank, it doesn't really matter what interest rates are doing. I'm going to buy the properties and do what I do. So keep that in mind, you guys. Just I wanted to highlight that relationship between buyer and seller activity. I mean, just look at the gap, right? It's actually remained fairly tight. It's not this yawning gap that we've seen when we've seen a divergence between supply and demand. 3 distinct phases, eras over the last 3-4 years. I like to break this down just so we can kind of get on the same page. Look at the pre-COVID era, 2019 through, I guess, March of 2020 when the world changed. Pre-COVID, sales up, down 5-7%. COVID boom, sales up 40%. Fed poured cold water on that with higher rates, and now we see sales down 20-30%. So again, pendulum back here kind of overswung before it kind of hit center. It's like the green and blue chart at the beginning, right? Kind of here, way up and then kind of way back down. It never just stops in the middle, but that's kind of where we want it to be. A healthy, balanced, sustainable market where buyers and sellers are well matched up. Supply and demand is pretty well matched up. We still hear this as today, like 15 years ago. No, it's not. Here's some reasons why, right? Job cuts. Careful here, guys. This is a few months old. It's not none anymore. It's probably a couple 100,000. Some of the tech firms are laying off. Some high growth companies that were funded with cheap money are no longer finding that they're able to grow like they were. Total jobs, right? 20 million more. Subprime loans, virtually non-existent now. New construction for the rolling previous 5 years, we're still well behind. Inventory on market, a quarter of what it was. I mean, we're not just talking 10, 20% lower. You're talking a fraction of what it was. Delinquency rates, a third of what they were. And then homes in foreclosure, an eighth, a seventh, an eighth, a fraction of what they were. So this time is very different, right? Very, very different period. All right, I like this one because it kind of gives us a little bit of a forecast. One possible scenario. So this is October, I know it's a couple months old. I'm using October because the data just moves pretty smoothly. So look, guys, these are actual closed sales. Look at the COVID boom, and then look at the cool down with higher rates. In dashed blue, that's where sales would be sort of assuming this linear trend. You guys with me? Yeah. Now, here's one scenario, our forecast. That's dashed red. So we were way up, we're way down. Eventually we get back on track. It's just a matter of time. We don't know if it's going to be a year or 2 or 3. We just don't know. It can be messy, right? Sometimes we'll overshoot, sometimes we'll undershoot. It can be messy. So just be aware of that. Diving a little bit deeper. We're still on January numbers. We're updating with February numbers this week. So we don't yet, we haven't pulled all the latest status changes for February. So we're still stuck on some January numbers. What do we see happening with new listings? I see as low as we've been for January in 21 years. That's what I see. Pendings down 19%. Nice little pie in the sky. Is that 05 looks like? 4,000 something. How about closings? So pendings, closings, pendings, closings. Pendings are always the thing before the thing. They happen before closing. So what do they say? You want to know what closes tomorrow? Look what's under contract today, what's active yesterday and listed on Saturday or whatever, right? You guys get the idea.
That's units, not dollars.
That is units listed. Yep. Or excuse me. This is units listed, units under contract, and units closed. Yep. Reflecting all the status changes. CDOM, cumulative days on market. How's this one looking? Well, I mean, depends on how we look at this chart, right? We look at this chart and block out everything over here. Holy cow, that's almost a plus 100% increase. That sure looks spooky. That's going to sell subscriptions and eyeballs, and that's going to get people to look at our ads, won't it? Right, so I better blast that. I don't care if you're on CNN or Fox News. It just doesn't matter. So look, 22 to 44 would be doubling it, just about double, but here's the key. It's back to where it was. It's kind of back to where it was. So when we show this chart, if you don't have the history, you're missing something, or you're deliberately misleading people. And I don't think either one's good, right? You're either omitting something or you have ill intent. Those are bad things. Don't do those things, right? Don't do those things. So 43 homes are actually selling more quickly than in 18 and 19, and even with 2020, most of which was a COVID year, about half of which was a COVID frenzy year, if you will. So 43 days, guys, wow, you know, in 3 weeks, 21, 22 days, buyers don't have a lot of options, right? Well, honey, you know, I saw this yesterday, but it's gone today. It's going to be gone. Why bother? And it is gone in 22 days. Now they got another, right, couple weeks, another 3 weeks.
Just for the month of January.
Just Jan. That's Jan of every year back to 07.
And it's cumulative days. So somebody could have tried to sell it in the fall and not sold it and then put it back on in January.
That's it. And
it would have counted in your graph.
We would keep the days counting. So some folks are on for 30 days if they don't like the showing traffic or the offers. TNAS for 10 days or whatever, just delist, and then a coat of paint, floor sanding, whatever people do. And then we count the 30 days plus the other 20 for 50 true days on market. You're not going to fool us. Stop trying to trick me.
What's so interesting is these days it almost seems like you don't even need to do all that stuff. All you literally have to do if you've been on the market in the fall is just wait the calendar for the next year.
It's actually interesting. So why might prices not fall? We saw demand go way down, but also supply. But sellers have the option to do what? Just delist. Just take it off the market. I don't have to accept less. I'll just try again this spring or this summer or whatever. So we are seeing that. I actually do have some slides on that. We are seeing a pretty substantial increase in delisting. You guys have seen that. I'm saying not. Okay. This is good. Original, you know what? Original list price is not as sexy as, hey, my marketing and communications folks say that it's too many charts. You got to break it up. So pretty things. Yeah, just take a moment. Breathe. Tim's meditating on that one. Yeah. All right, median sales price, guys. January, what do we see? Price is up, but not by a lot. All right, let me zoom in. Price growth only 2.7% in January, right? After 10.5, 11.5, I guess 4 and 6 and right. So that's the slowest rate of price growth. Oops. That's the slowest rate of price growth since a decline, right? And what is that going to be? 2012, 11, 12, 12, right? I got to change my font. It's getting a little crowded there. So you guys can see kind of what's happened lately with price, right? And kind of, I like the history. Some people say, why do you go back to 2003? Well, we get the run up in the bubble, the downturn, and then, kind of the strength that we've seen, especially the strength over the last few years with 11.5 and 10.5 clearly being above average, right? Or I should say above the median. How do you like that? PPSF, we know there are bigger home selling, right? New construction, bigger, always bigger. 2,800 versus 1,800, right? Some 3,200, 2,400 versus some 1,600s around here, 1,200, 1,400s around here. So 182 per foot. I don't care if you have 600 square feet or 6,000 square feet. What are you paying per square foot? So what are buyers offering and what are sellers accepting per foot? What does this do? This standardizes our data by TFSF, total finished square footage. If we've got bigger homes selling, well, bigger homes sell for higher price. So it's going to move prices, but that's reflecting bigger home selling. What about actual values on existing homes? Let's divide out by price. Let's divide out by square footage. So a $400,000 price tag divided by 4,000 square feet is $100 a foot. A 2,000 square foot house. So let's imagine this is $200 a foot. A 2,000 square foot house times 200 a foot, going to get you to your 400,000. And sure enough, we're at what, 365, 370. So we're getting there, right? Because we're approaching 200 per foot. Percent of original list price, guys. This one really shows some deterioration, right? This one really shows a slowdown, a cool down, and it really speaks to the offers that buyers are willing to write, right? And actually, on the flip side, what sellers are willing to accept. Sellers used to accept 99.5%, right, during the COVID boom, 21 and 22. And then now down, a couple months ago, down to 96%. Well, these are kind of pie in the sky, pretty unique period in 21 and 22. Also note, 96 is not that far from sort of average. Look at in the bubble, right? Saw some 96s, 97. So it's really not that far from sort of the historical average, if you will. I really do like that this one shows change. This one really does show change. And I think it reflects what we're hearing and what you guys are seeing out there. Percent of original list price, percent of current list price. This is important. Why? Price adjustments, reductions, and SSP, seller selected pricing. SSP. You guys know that one, right?
What's SSP?
Seller selected price. She's laughing at me. Seller selected pricing. Look, I'm telling you, your home's worth $350. We're going to list it at $425. Seller selected pricing, SSP, right? So this says out of your original list price, you're only going to get about 96. But once you're adjusted and have a current list price that's in tune with the market, now you're getting 99.5%. Right? So now you're doing pretty well. So pricing matters. How you guys help your clients price these homes matters. It impacts days on market. And obviously this one, the ratio of sold to list price. Inventory, we've got plenty of it, so we can just keep moving. Yeah, guys. We had 5,600 listings at the end of January. 5,600. We used to have 30,000 plus. Go. So plus 16%. That's good news, right? Somewhat good news because there's more options out there. It's not quite as tight of a market. It's not quite as inventory starved. So plus 16%. On the one hand, I fear buyers are going to look at this and say, oh, Mr. Agent, or, honey, we can go around and lowball sellers because look, there's 16% more inventory. This is our market. This is now a buyer's market, right? This is our turn. This is our time, baby. And then, you might think that if you just focus on the last 2 or 3 years, the reality is we're still well below pre-COVID 18, 19, and 20, and we're barely ahead of 21, right, guys? Just barely. So before we celebrate plus 16%, and maybe we can cautiously celebrate that for a moment, but let's keep in mind, we're still in a very low inventory environment, like Tim said. We're looking for 20,000 active listings. That would be here. We would be here. Why? Because we're selling about 5,000 a month, right? Or 4,000 a month to get to 20, right? So we have 5,000 actives. We need 20,000 actives to get to that 5 months of supply. And you'll see in absorption rates, we're sitting at 1.3, right? We're sitting at 1.3. So 20,000 in inventory divided by 4,000 sales a month equals 5 months of supply. That's what we're shooting for. Instead, we've barely got over one. Still, right? So yes, up from 0.9 when we had 3.5 weeks of supply. What is that, 3.5 weeks of supply? What a shame we're measuring it in weeks. We're still below 2018, 19, and 20. I think that matters. I think that's missing from the national conversation. Ooh, pretty cool. Nice one. Oh, another nice one. All right, anyway, back to charts. Back to charts. Stuff I'm decent at. All right, guys, so this is annual. So we were just looking at January. Sometimes a month can look pretty extreme depending on rates, weather, the fact that it's just 1 month versus 12 months, right? They say most people age about 12 months each year. Me, I get 18 months older every year. I swear to God. Chris gets younger every year. I don't know how you do it. I don't know how you do it. Anyway, guys, annual new listing. So January was down, what, 19, 20%? For the year, we were down more like 10%, right? So not as extreme when you look at the year. But 68,000, right? Just barely ahead of our low, right? Our 20-year low. There you have it. Pendings down more like 20%, closings down more like 19%. Here again, pendings, closings. Guys, look at how close these move. Pendings are the thing before the thing. But God, are they close. So let's just pause on closings for a second. So it looks like minus, let's call it 20%. Is it really fair to compare to 20 and 21? Probably not. That's not really a comparable market. What I would do is maybe let's average the 2 or 3 pre-COVID years, or even one. Looks like 60,000 to me. So what's 54 compared to 60? That's minus 10%. Because 6 is 10% of 60. That would get you to your 54,000. It's more like a 10% pullback if you don't compare to these ridiculous high water marks. When everyone and their mother and their stylist and their former supervisor was buying homes. Oh, not bad. All right.
Favorite one, probably.
Look at me up in my game. Yeah, tier one, peer one. My favorite one. Yeah. Oh, your favorite one. Like, tier one. Like you got to say it. Yeah, cheers. Yeah, very, I like that one. Kind of cool. All right. Anyway, days on market, guys. How do we look for the year? We saw January. What was that? 43 something. For the year as a whole, we were 14. Right? For the year as a whole. Homes used to sell in 100 plus days. Market time is definitely coming down. Adoption of the internet, right? Other technology has surely helped. But also, there's not enough supply given the demand. That means homes don't linger on the market for long. You guys know that. You live and breathe it. You understand it well. Call it a 30% increase in market times from 11 to 14, right? So a week and a half to about 2 weeks. Can sound extreme. 30% can sound fairly extreme. What was it, January? 95%? You guys remember that? Here again, can't just look at 2 years. You have to kind of put it in context. Homes still selling more quickly than in 18, 19, and 2020, but not quite as quickly as 21. Sales price, 6.5% for the year to 362.5, compared to 9% and 11.5% in the prior years. So reflecting a slowdown in price growth, but not price declines. Let me say that again. We are seeing deceleration or a decline in price growth, but we are not seeing price declines. Prices are not softening, but the rate of growth has slowed. And that's a good thing probably, right? How many folks, incomes are up 11, 12, 15% every year? Probably not that many. Hopefully some of you, that would be great. But probably not that many. So, 3, 5, 6%, a little bit more in line with kind of where folks are at. It's okay to pause and give incomes a chance to catch up. That's okay, right? That's not a crash. That's okay. Price per foot for the year, which is obviously skewed by May, June, July, spring, summer markets where, price per square foot is always higher versus January where we saw 182. So about 191 per foot. And look at the slowdown in growth. Guys, this is important. Once we take the size of the home out, the fact that bigger homes tend to fetch higher dollars, now we're showing prices only up 2.5, 2.75%, right? Not even 3%. So definitely price growth slowing, but still positive. That is the slowest rate of PPSF growth since a decline, right? Slowest growth rate since a decline. I don't love how this metric ended up last year. I really don't love it. I don't feel like it's representative of what happened, but it's the fact. So I'm here to share with you the facts. Last year, the average percentage of original list price that sellers were accepting or receiving was about 101, down from 102 in 21. Why don't I like that? We talked about January, how that 96, 97% number is a lot more kind of reasonable and realistic. What's happening here? This is going to be boosted by the first half of the year and depressed by the second half of the year. And didn't we all get depressed by the second half of last year? Mental health is not a joke, actually. So guys, 100.9 compared to some bubble, compared to the crash, you guys can kind of see how this looks. How deep is the mud? Depends on who you ask, right? It really does. I actually really kind of like this one. Ask some folks it's ankle or knee deep, depending on your canine anatomy lesson. And then ask others and it's neck, it's shoulder or neck deep, the mud, right? So depends on who you ask. As long as we're talking dog jokes. Ever since I went to the vet, everything's been loud as heck. Sometimes I think we need these to stop us from looking at our phones. Anyway, I think that was, yeah, it's kind of true. Anyway, don't scratch them. Don't scratch it. I know you want to. So guys, everything's relative. So, we're just one region in a beautiful nation with many different metros and areas. None as good as this, but there's a lot of different ones. How are we doing? Minneapolis, here we are. Year over year price change. How are we doing in Phoenix? Our Phoenix friends, price is 35%. That's a $300,000 house this year selling for $400,000 next year. How's our friends in, I thought I had Tampa. Oops, Miami. Tampa and Miami were right up there. So look at Phoenix kind of peaking early, and then Tampa and Miami, well, if Tampa were on, you'd see it peak a little bit later. Look at our friends in San Francisco. But look at how strong they were, right? Price growth, twice ours, but now they're negative. And guys, everyone who was above us, look, they're now kind of with us. Everything's kind of synced back up into this 5 to 10% price growth trend, because that's the historical average. Everything's reverting to the mean. You saw the chart, guys. Everything is reverting back to the mean. It's getting back to these kind of historical averages. This is not typical. This is exceptional. We had a pandemic, in case you were asleep, right? So this really illustrates for me that the higher you climb, the harder you fall. Don't tell Cotty. Just saying. I'm just saying, he should be careful. These people should be careful. So, we did not see the, kind of insane growth that other regions saw. So now we're kind of leveling out. Well, I expect other regions to probably come down. I do expect some other metros to lose, to see softening prices. I don't know if we will. Tim, what do you think? We could. What? Softening prices. You were saying that if we didn't see it in February, we probably won't.
I'm going to say March is a possibility.
You think March is possible? Let's check in early April. Yeah, I mean, it's really anybody's guess. And a lot of it is the product type that's out there. So a lot of the 250s and 300s have already been snapped up and they're not coming back on the market. What does that leave? 500s in Lakeville, 450s in Blaine, 2.8 in Wayzata, right? 1.3 in Edina, 550 in Eden Prairie, Bear Pass. I mean, so what does that leave? How about 11 and Four Seasons? Where's Cynthia Freud is out. That's her thing. That's her baby. So those are all 1.1s, right? So that's 1.1 is cheap.
Yeah,
Didn't the first sell? That's entry. Oh, geez. Oof. Excuse me. Oh man. Better increase my savings rate.
Waller showed up fast.
I actually talked to some of the Sotheby's guys. Is it Waninger, Mullen, and Ben Ganji? Right?
Yeah.
I was talking to some of those guys, and they were saying, and this was maybe 6 months ago, they were saying of the 90 units in 11 or 100 units, they said they had 2 cancellations. 2. Surprised me. And that's in downtown Minneapolis. And these are ultra high net worth individuals who can live wherever they want. They're making a choice, right? They have the freedom to do pretty much whatever, and they've kind of made a choice. So I think that's pretty compelling. I want to give you guys the links here, and we're not quite wrapped up. not quite wrapped up. I want to leave you guys the link so you can see that interactive chart. So you'll have those. Oops, Trish wanted a photo. One more. I promise you guys will have the slides, but I know I live and die by the camera roll on my Outlook calendar too. I'm the same. Price reductions. Who's excited to see this? Yeah. Or are you just stretching?
Oh, stretching.
Oh, okay. Admit that you're excited. All right. So guys, you know, this didn't used to be a metric that we captured. This didn't used to be a thing that we reported on. And then could it have been this off? I think there was some of you here that were really wanting this, and a couple others, obviously. So we started to track it. We started to do it. Price reductions, 03, 04, only about a third of the market. Market crashed in the Great Recession and the mortgage and foreclosure crisis. Over half of the sales needed a price reduction. Things sort of got better. Now we were more like a quarter or a third. No need to reduce prices in 2020 and 21, right? Because I had 10 cash offers after you. You want a price reduction? Take a hike, pal, right? Take a hike. It just wasn't a thing. That wasn't what happened in those years in the market. Now, 29.8, oh boy, you know, that's 50% more. 30 is 50% more than 20. But it's flat with pre-COVID. It's flat. That matters, guys, right? So again, I think media, you know, whomever, you know, is kind of teasing out the pieces that sell the stories, right? That kind of sound extreme. And by the way, you know, Strib and NPR, I mean, it's not just Fox, you know. Percentage of sales with a price reduction. This is annually. So this was October, guys, so a little bit dated. This is annually, which includes all of last year. So not quite as dramatic of a change, now more like up a third versus up 50%, but still below 2020 and notably below 18 and 19. Can you check chat real quick? Good morning, David. Oh, Jim. Hey, Jim. Jim Camarada, my guy. I miss you, Jim. So percentage sales with a price reduction. Closed sales, property type. What's going on here? A little small. Let me zoom in a little bit. Single family, I see down 33%. And this is just January, you guys, not a whole year. Condos, interesting. Flat, down 5 or 6%, right? Flatter. And then townhomes also down 32, almost 33%. What is the most affordable price point of these three property types? Condos. It's always condos, right? So maybe no surprise that that was not the best. That was the least bad performing segment. We saw the slightest decline. Everything was down, but we saw the slightest decline there. I think that could have something to do with it. How about by construction type? New construction sales down about 8 1/3, but look in red, previously owned or resale or certified pre-owned Beamers, baby. You know, down more like 20%. Obviously, better price points on previously owned. New construction now 400, 500 in a lot of places. Existing still 350, 380-ish. And you guys can see we are a majority existing market, right? New construction, what is that? You know, 10% of our market, not even 10%. By price point, under 500K in blue, over 500K in red. Closings, just closed sales. So I don't know if you can call 475 affordable, but for the you know, more affordable end of the market, under $500,000, we see a 24% decline in sales. Over $500,000, up 1%, up 0.8% still. After 47% the year prior. Well, that's something that I should take note of, isn't it? That's different and unique and compelling. Let's slice and dice it a little bit more. Instead of under half and over $500,000, let's go under half, $500,000 up to $1 million, and now $1 million plus. And now we see an even more interesting trend, right? So we're actually flat between $500,000 and $1 million. You can't make that up. 5, 36 versus 31, 5. You love it when the numbers work out pretty well. Anyway, it's about as flat as it gets, you guys. But $1 million plus after 51%, still tacked on 7.5%. Guys, luxury market is a growth market. It has been for a couple years, three years. Right?
A lot of that is just depreciation.
What was 950 is now 1050.
When you look at Hennepin County under 300,000, it's remarkable since COVID how much fewer transactions there are.
It's just down.
Yeah,
It's really noticeable.
It's appreciation.
Yep, I think you're right. So yeah, what was 875 5 years ago is going to be 1050. What was 975 last year might be 1.1. So
This stuff is over 500 now. That
exactly.
A lot of stuff.
Yeah, it's a really good point. So that has just been kind of incredible. I don't know, not a surprise when you think about it, but I didn't expect a 51% increase in million plus. I guess I was thinking 10, 20, 30. So that really shocked me. A lot of folks talking about our two beautiful core cities, Minneapolis and St. Paul. Sorry, St. Paul. Rent control in St. Paul, opening it up to maybe do it in Minneapolis. Are people running for the hills? No, actually sales were down less in the core cities than they kind of were in the metro as a whole. No meaningful difference here, right? No statistically significant difference, despite what some were probably expecting. All right, if this doesn't scream luxury, I don't know what does. Where's that one? I think it's Brackett's Point or Orono. Some is probably one of those. I don't know. Anyway, closed sales over $1 million, guys. There's your 50%, 7.5%. Holy cowbells. 500 to 1,500 is a tripling in the market. That's a tripling, right? Forget that. It doubled in 2 years from 750 to 1,500. It pretty much doubled in 2 years. That's insane.
That's units?
That's units for the whole year. That's units.
It's appreciation and easy money.
Easy money. It may take a little bit more time, but do a flyer, make a mailer, social posts, go to Minnetonka Country Club. Yeah, this has absolutely been a growth market. I mean, guys, 25, then 50, then another 7.5, despite most of 22 being higher rates, right? Especially second half. Days on market, million plus, 3 weeks, 21 days. Guys, it's astonishing. You're talking 260 days. I mean, even 70 days. I mean, that's 2.5 months, right down to 3 weeks. Insane for million plus to be selling like that. Absolutely crazy. How about ratio of sold to list price? Million plus sellers are getting 99%. Are you serious? I mean, 95 used to be great. 95% used to be fantastic offer for million plus. Now, if you offer 98.5, they're going to kick your butt to the curb because we got better offers waiting in the wings. Astonishing. Again, not surprising when you really think about it and kind of dig in, but I would not have expected it to be quite to that level. That did surprise me. Absorption rates, million plus. Used to have 30 months of supply, 30, not 13. 30 months, right? Now down to 13, 12, okay, 8, 9, and then down to 3 months of supply for million plus. It's unheard of. It doesn't happen. It doesn't happen. It's unheard of. See a little bit of normalization, right? To about 4 months of supply, still a seller's market. Guys, well, duh, it's got all the hallmarks of seller's markets. Sellers are getting ridiculously strong offers in record time and demand is soaring. Duh, that's the definition of a seller's market, right? No kidding. I'll take things that are obvious for 800, Alex. Daily double. All right. Pretty astonishing. All right, should we pivot to InfoSparks? Well, let's give it a minute. Time check. How are we doing? Okay, about 15. Okay, yeah, we're good. Well, probably talk about this guy. This is your guy, Jerome. This is Mr. Chairman of the Federal Reserve, who allegedly knows what he's doing. And he tells us that, right? I'm not here to, bash the Fed, but I will say, when you turn the wheel on an oil tanker, is the thing going to be able to do a U-turn on France, right? Well, no. This is a $31 trillion economy. He's been yanking on levers and dials and knobs, and we're not stopping to see the impact of our actions. So we've yanked the wheel. Ship isn't turning much yet, but it's gonna. And if you keep turning the wheel, it's gonna really kind of do things, right? So I'm personally of the belief, and I'll say that these don't necessarily reflect the views of my employer. I'm personally of the belief that they're overdue for a pause, that they really need to pause let folks catch up, let things kind of calm for a bit, let folks adjust to a 5.5%, 6%, 6.5% rate environment. And it doesn't seem like they're that keen on doing that. The Fed, I can raise and lower interest rates at will. Why would you want to raise interest rates? So I can lower them, duh. Yeah, that makes total sense. All right, let's get out of this, you guys. Let's shift gears. And let's get into some other fun stuff here. Okay, first things first. Nobody cares about the Committee on Jobs and Economic Development from the other day. I guess I did. Don't ask. All right, let's look at rates, guys. Some of you still have the rate sheets near you, this old guy. Let's talk about it real quick. I think we'd be foolish if we didn't touch on it. So here you go, folks. By the way, Fred, tremendous system. It's the St. Louis Federal Reserve. Tremendous, tremendous system. You can search for virtually anything right here. Anything. How are we doing in the early 80s? There's our 18%. I didn't make it up, promise you. You don't remember, ask your parents or your uncle or something. And then let's zoom in, guys. I don't want to have all that history. Let's zoom in a hair. So last time rates were 7%, I believe, was 06, was it? Yep. So just barely flirting. So 6.8, right? Where are we now? Look up here. We're 6.65. At least that's national. That's national, right? YMMV, your mileage may vary, right? Your results may vary. So look, is this the trend? I mean, is this our new trend? I mean, was that our trend just down kind of forever, right? Well, this was the exception, you guys. This was the exception to the rule. You guys can kind of see us normalizing a little bit here. So I don't know, maybe that's where we belong. I hate to say that. I really don't want to say that, but it's probably where we'd be if we didn't have that. So again, this is not the norm. 30-year fixed rates at 2.7, 2.6% is not the norm. Don't get accustomed to that. Don't get used to that. Yeah. Okay. So that's a little bit on rates. Let's hop into. Well, hang on. Let's hop into our website real quick. Most of you guys know, I won't spend a ton of time on this. You guys know where to find our reports. Let's just click on the local market updates. There is actually one that you guys may not be aware of that I really do want to kind of talk about. This is where I think you guys are going to be spending most of your time. We've got monthly indicators, well and good, HSO, housing supply, foreclosure reports, all well and good, but the local market reports do something that nothing else does, and that's break things down by geography, right? So Hennepin County, Minneapolis, Calhoun Isle, let's do Lowry Hill. Wow, prices. Looks like a condo for 185, and then look, one closed sale for 600,000. Looks like a single family for 600K. So sometimes things can move in a pretty extreme fashion. That's why we have rolling 12 months. Check it out. Well, now we've got 60 sales. That's much better data. And now we show, okay, prices down, 5 to 9%, a little bit more in line with reality and expectations. 8 homes on the market. Wow. So this guy was asking what, 900,000 if they accepted, because that's just one sale. We might look that one up. I mean, you got do it on your own time. You guys do it. It's like your sale and none of your deal. Okay. I'll let you guys do that. But just know that you see that stuff sometimes. Let's hop into one other real quick. What should we do? Do Bryn Mawr? Okay. Bryn Mawr. I like Bryn Mawr.
The north side neighborhood that wants to call itself a
little coffee shop. Coffee shop there and a pizza place by the gas station over there. Yeah, I like it over there. Good stuff. It's good stuff. 2 listings, down half, closed sales, 3 flat. Average sales price, okay, yeah, it's definitely some nice product selling. But over the last year, more like 480, right? Versus 760. So it looks like these 3 sales in January were high end, skewed a little bit toward the high end, which is okay. Half a month supply in Bryn Mawr, right? So there's 3 active listings. Careful here, we divide the 3 by the average pending. So this is closings. So we actually use the average of pending. So that's why three inventory, 3 actives divided by 3 closings sounds like 1 month of supply. It's actually half, right? Because demand is usually higher than that. What else, guys? One more? What do you guys feel like? Let's go over, let's do Linden Hills. Let's do a high-flying market. One of those sexy 50th and France markets. Kind of sexy as Bryn Mawr. Not quite as sexy as Bryn Mawr. Bryn Mawr, pretty sexy area. Anyway, so Linden Hills up 17.5% for January. Pretty flat though for the year, right? Flat at plus 1.5%. So pretty flat between 660 and 670. Last January, folks getting 102%. This time they're accepting 93, right? That's a difference. 1.4 months of supply, 18 actives now. You guys can kind of see how that looked over the last year or so. So that's the local market updates. You guys know about that. You're familiar with that. Let me hop back to our homepage and show off something you might not be familiar with. We've actually had this for a year. Yeah, about a year. So from our homepage, I'm just going to click on market data. Darn it, I got to have our folks fix the link. It's the one I want to show you too. Sorry, it's the broken link. Click on sortable stats. The link will be fixed. Who's familiar with this? Tim's seen it. Okay, good. So sortable stats are exactly what you think they would be. We've got all these different communities, neighborhoods. Yes, we had to include St. Paul, and then cities, Afton, right, Apple Valley, Arden Hills, areas you guys know well. And then there's this piece. Sort by price. Minnetonka, right, Longfellow, Southwest, okay, no surprise. So that's, let's look at cities, or neighborhoods. Is that Kenwood? Always Kenwood, 1.3, followed by Page and then Bryn Mawr. And then, oh, look, downtown East. So 11, Easttown, is that called Easttown now? Yeah. Mill District, I'll still think of it as the Mill District. Guthrie and everything else. So pretty high flying there. So that's if we look at prices, high to low. How about we look at price growth, or I should say price change, high to low? Oh, interesting. So Longfellow actually is where we're seeing the most, but it's not from a ton of sales, so be careful. Let's go cities. Well, no, let's pause at neighborhoods. So Lowry Hill, careful guys, this is only from 1 sale, right? Hiawatha, pretty good data here actually from 15, right? So just be careful with the onesies, twosies. I just urge caution with the onesies, twosies. Days on market, where are homes selling in the least time? Northeast Minneapolis, of all the communities, how about neighborhoods? Guys, 0 sales, so 0 days on market, right?
Can you do 12-month data?
Not yet. I've asked them to. Not yet. I really do want them to. Or at least a special run for last year to show all of last year. We're going to get it.
This is pulling, we go back up to the top.
Yep.
So when it says, is this pulling from February then?
So this is still on Jan.
This one is still Jan.
We'll have Feb beginning of next week.
Okay,
You'll see Feb.
up there because there it is.
Exactly,
So
yeah.
And it's only monthly. It's not, you can't do, right now, it's
Only monthly, yeah.
Right. So when you're looking at, say, Minneapolis Central, it's closed units 39 was the month of January.
Yes.
Got it. Okay.
Yes, exactly. By the way, Central, let's give it a click. Look at what it pulls up. They talk to each other.
Cool.
Are you excited?
They huddle up. You have no idea how excited I am. Oh, the little things, guys. It's the little things. Life is just a bunch of little bits of joy. So yeah, so it does talk. So even though this is sortable stats, it basically pulls from our local market updates, a totally different report. We wanted to create this ecosystem so you guys can be awesome at your jobs, right? What else? Let's do a couple others. Okay, so things selling pretty quickly. Wyden, Longfellow, pretty interesting. St. Paul downtown, taking a long time. St. Anthony Park, Summit Hill, definitely some fairly elite product there. You can see higher price points. Cities, why is that taking a long time? When everything's 1.1 million, they're going to wait for a little bit. Although we just saw they're actually not waiting for that long, but apparently, you know, some of those are in that area. You guys can see, you know, kind of how things look from there. What city? One day in Montrose. From the 2 sales, wow, each of those must have been a day. Right, Oak Park, Delwood, Loretto, some smaller townships. There's Hutch. All right, quick time check, guys. I know we're coming around on time. Let's just do a few here. I know you guys are pretty familiar with this. I know, and I'm so glad you're familiar with this. But any new agents on the call or here or folks who just aren't as comfortable, I just want to do a quick walkthrough. So InfoSparks, how do I get there? Matrix, right under tools, also under external links. By default, you're going to be looking at the median sales price, right? That's why you see, make this a little bit bigger, not that big. That's why you see 365, right? Because we're looking at median sales price. I can look at pending sales. I can look at month supply. I can look at percent of original list price. And there's our 90. Well, nope, this will be 12 months. So this will be about 100. Yeah, about 100. Let's look at monthly. There's your 96 or 98. Yeah. And by the way, that's median. Average. There's your 96, 97. So I like to think of the tool as having 4 prongs. Choose your area. It can be anything. Just start typing. It can be a zip code, 55443, anything. It can be a neighborhood, Linden Hills. It can be a county, Anoka County. It can be a city, Rich Field. It's anything, guys. It's literally anything. So, you can put in any area. You can compare areas. Let's compare the Twin Cities to our beautiful big core city. 97.2, 95.5. How about on the price front? 290 versus 342. You see a lot of bigger new construction happening in the metro and the Blaines and Lakevilles that we just don't see here, right? Market times 64.45. So some important differences here. So step 1, choose your area. Step 2, choose your metric. We already kind of played with this. We looked at sales price, month supply, days on market. Choose your metric. So choose your area, choose your metric. The third prong, I think, is where a lot of the magic happens. Choose your segment or your variable or your breakout. So let me get a hair bigger here. So 342 is the median sales price for the metro. For single family, it's 370. For townhomes, it's 285. And condos, always bringing up the affordable end, still 197.25 somehow, right? How about new construction condos? $500,000. Suddenly $500,000, right? But there are some affordable ones spread out across the metro. Okay. So area, metric, what do you want to look at? Variable, how do you want to break out the data? By the way, guys, speaking of breakouts, what we just did is filter. We filtered down to single family, filtered down to townhouse. But what I want to do is break out. Let's break things out. So careful, instead of just filtering and filtering, now we have to do our breakout. See my little ripple thing? Nice little custom thing that Windows offers. Anyway, you got to click breakout, you guys. And now you'll see from 1 to many. Right now you'll see from 1 to many. I don't want to see all, I don't want to see townhouse condo. I just want to see my big 3 property types. And there you have it. Single family 370. Why is that blue thing there? Go away. Looks like it's not going away. So there you have kind of all your big ones, right? And if you want to look at this, sometimes it'll make sense to look at it in a bar chart, right? And that's a nice view as well. Kind of interesting. Single family actually down 0.2 from 370, 800 to 370 flat. Not much to write home about there. And you guys can see how condos and townhomes look from there. Questions, thoughts, concerns? I know most of you use this and understand it. So this was a review for most of you. But I really, yes, absolutely. I really encourage you guys to use this. I always say each and every one of you is paying 12 cents a month for this, 12 cents a month. I know it's a big investment, but if it's free or $1,000 a month, you guys should be getting value out of it and using it, leveraging it with your clients or yourselves to just understand the market better. I mean, guys, many of you will be 20 or 30% less busy, right? Not all. Some of you might find you have 10, 20% more time. Get a certification, learn InfoSparks, right? Take a course, educate yourself, invest in yourself. There's just a lot to master here and in the rest of our market stats. And to kind of understand that's just going to make you guys better when things change. It's just going to make you guys better at what you do. Time check. How are we? You got a thought? Oh, here we are.
Right there.
Let's say one more time.
How did you get to that tab right there?
Yes. Right from our homepage, mplsrealtor.com. You can just scroll down and click on any of these. So I'll click the local market updates. and boom, it'll take me to fast stats. I also encourage you guys just to bookmark it. So just throw a bookmark and then it'll just be there. Yeah. Yep. Good question.
Can you show the group where your monthly webinars reside?
Yes. Yes. Let's see. Back to our, slides. Yeah. To register, what do you have to do? You got to find it. Yeah, and some of you do come fairly regularly, so thanks for that. I don't know why our calendar isn't wanting to load today. Maybe it is a little slow. So where am I? Our monthly housing market update. So I'm the third Thursday of every month, 1, 2, 3, third Thursday. And all you have to do is register. Totally free, but we do ask that you register. So Tim is talking about some of the other sort of custom stuff we've done over the last few years. Let's go to market data. Monthly webinars. There's and then webinar slides. There's my goofy mugshot. That's a while ago. That's my COVID beard. I had a little bit of a more full beard. And so, yeah, webinars, replay them. They're on YouTube. They're out there for you guys. And then last thing I do want to show you, you guys are going to get a kick out of this. And you know, we're running pretty shy on time, but I just want to show you guys the weekly pulse. So every Monday, we run this new kind of weekly blog. And it looks sooner. It takes a peek at the market sooner than anything else. So daily showing activity, right? 2019 all the way through this year. Yes, no surprise this year, a little bit slower. But looks like we could be catching up and kind of syncing up with 2019 levels a little bit. All right, what's next? Daily showings, yeah, so we kind of smooth out the trend. So this is where the magic sort of starts to happen. Showing activity by price point. So overall, showing activity down about 30%. But look at this, 800 up to 1 million. Actually, there were 17% more showings this year compared to last year. Everything else down 20 to 30%, right? So that is evidence of some strength in that market, in that segment, in that price point.
Isn't that relative to what's on the market?
It is, but there's nothing stopping me from scheduling a showing on a 400, right? Last year versus this year. So I think it's the change that we're measuring. So you're absolutely right that it has shifted toward more of that higher price product. You're absolutely right, but there's more showings on that, but not as many on, the two segments kind of flanking it. So it does tell us that maybe folks who moved up from 300 to 500 are now looking at the next move up. It could tell a story like that. It could tell a story. All right, a couple more, guys. I know we're at time. So this is the percentage. So this is the number of showings, but then this is the percentage of the whole, which I find useful. Oh, look what I just did yesterday. Oh, I love this. This is new. Change in showings right here. Interest rates over there. All right. How cool is that? That's cool. Right. So, rates were kind of cooperating right into kind of early this year, 6. I think we might have touched 5.9. And then, look at this. And then showings kind of reflected that. And then maybe they were leveling out. And so showings only down 25% versus down 30, 40%. Maybe we're reading a little bit too much into the tea leaves, but you guys get the idea that you can kind of track. Talk to any buyer. What's the biggest hurdle for them? It's rates. It's rates.
It's a good graph.
It's worth noting this relationship. And by the way, we will see changes in demand and showings first, always, right? You list it, it's active, you show it, it's under contract, then it closes. I call that the life cycle of a listing. There's a life cycle of a listing. So this is the thing before the thing before the thing. It's the leading indicator. All right, last one.
David, is there any way taking into account off markets? I mean, because it seems like we did a lot of off markets the past couple of years because things were selling so fast.
Yeah, we don't report much on that, although, I didn't show my delisting one. Afterwards, if you can stick around for just a few minutes, I'll share that one with you. We don't do a ton of with off market. We just don't, minus the sold off market. We don't do much with like expired or canceled or withdrawn. Well, I suppose the delist data would be withdrawn from market or taken off. So a little bit, but not a ton. Not a ton. All right, guys, not much else, right? Change in new listings by price, change in pending sales by price for the month and then for the week. And then I like to plot them both, change in new listings with change in pendings. things down across the board, especially in the affordable segments where buyers are rate sensitive, the most rate sensitive, a little bit less as you get over our median bracket, which is there. That's all I've got prepared, guys. Thanks for sticking around another minute or two.
Where did you
Again, where this
Where'd
lives.
you get
Yes,
that?
yes, this guy lives. Back to our homepage, simply, well, here, it's just in our news feed. So just go to News, Weekly Pulse. Weekly Pulse. Yep, so every Monday that'll come out. It'll also be in our newsletter. So check your inbox every Monday. I know it's hard getting realtors to read sometimes. I'd rather look at charts than read words too. So I don't blame you. But there are charts in that, so please read.
David.
Thank you guys so much. Thank you, thank you. Hi.
Figure out how to do the class.
But
Yep.
Thanks, David.
try login.
Thank you guys. No, that's okay. So yeah, fast ads. So just do just go to mplsrealtor.com. Yep. No, that's okay. So that's going to be just from our homepage.